Nick, good to see you as always. Today we're talking
Wonderful
three
being here.
RMD strategies to reduce your tax burden. I know that you're always thinking of strategies to help your clients reduce their taxes. So let's talk about those required minimum distributions because proper planning is vitally important. What are RMDs and how are they calculated?
So it's almost like they shouldn't be called RMDs. They should be called FMDs, forced minimum
Yeah.
distributions, right? Because it's almost like the government says, hey, you save monies in IRAs, 401ks, 403bs, and all those accounts, what they call pre-tax accounts. And now they're coming to collect. You're over 72 years old, and we're going to force you to take money out of those accounts, whether you want to or not. And it's almost like, it's like me going to my kids and saying, hey, you've got $500 in your account. I want you to spend $100 of it today. It's crazy. You would think that was nuts, but yet that's what happens. The government looks at it like you saved up this money. You got a tax deduction when you did it. We're coming to collect later on down the road. You've kicked the can down the road on the taxes. Now we're coming to collect. Mm-hmm. So required minimum distributions are just that. They are required. They are forced upon us. And you got to take it out by the year following the year you turn 72. There's a calculator right here. And how they do it, what they do is the April 1 of the year following the year you turn 72, you got to take out your first required minimum distribution. They take the fair market value of your account, the account value, the preceding year, it would be December 31st of the preceding year. They have a little factor that they use, and then it spits out a number on the other end that says you got to take out X amount of dollars. And if you don't, it's not going to be a good day for you because we're the government and we can penalize you. A good resource, TD Ameritrade has a required minimum distribution calculator. You can go to Google and just type in TD Ameritrade RMD calculator, and that can help you kind of figure out, if you're trying to figure out how much should I take or need to take, and you're not working with an advisor, that's a great resource to be able to figure out how much you need to take, or at least get an idea of what you're in for.
Mm-hmm. You mentioned quickly penalties. So let's talk about those penalties because I know you work really hard to make sure your clients take those distributions when they need to, because if not, it is significant.
It's 50%.
That's nuts.
50%. I had a guy once who said, hey, Nick, Sam said, I got to take out $10,000, but I don't need it. I don't want it. So just write the government a note and just tell them I'm not taking my minimum distributions. And I told him, I said, Sam, that's not going to work that way, because if you don't take that $10,000 required minimum distribution, the penalty is $5,000.
Ouch.
5,000, 50%. So he said, I guess then where do I sign, right?
Right.
He didn't want to get that. But you got to be careful, though. That very first time you take a required minimum distribution, which is the April 1 of the year following year you turn 72, you got to take one distribution then. But then you got to take another distribution in the same year by the year end. So let's just say it was 2023 and you turned 72 right now in 2022. Here in 2023, you got to take your first by April 1 of 2023 and your second by December of 2023. So you have two in the same year. So let's say that you had $30,000 of minimum distribution you had to take, and you waited until 2023 to take that first one. And then you got another one in the same year. That's another $30,000. You might have $60,000 of minimum distributions, and that could push you into a higher tax bracket. So we call that the double RMD tax shock. Mm-hmm. So the strategy there is maybe that very first year, take the first minimum distribution in the preceding year. So it goes into that year, and then that way you have one RMD in one year and one RMD in the other. Mm-hmm. But another tip is make it automatic. I tell people you don't want to worry about this every year. Most companies will allow you to set up what's called a systematic required minimum distribution, where you can just set it up. The company calculates it and just automatically sends you the money for what you have to take out. That's the easiest way to do it. And another tip, I know this is like the third one here, because there's a lot. Taxes, there's just a lot. But 401ks and IRAs are different animals. Some people think, well, I know I have to take a minimum distribution from the 401k, so that should suffice the IRA, and it doesn't. They're two completely different things. So if you have 401k and an IRA, you got to take a minimum distribution out of the 401k as well as the IRA. But if you had, say, 50 IRAs, you could take the distribution. You don't have to take a little bit out of each of those 50 IRAs. You could take it all out of one IRA. They just have to be the same type of account.
Mm-hmm. Okay. So You touched on some of these, but let's break down the three strategies to reduce the tax burden that comes with RMDs. And you mentioned this a second ago, but consider early distributions. Why is that?
Yeah, early distributions, just because if you think what's causing this required minimum distribution problem is that you have a huge amount of money saved up in these pre-tax accounts. Again, 401ks, IRAs, 403bs. So you have all this money saved up. And when they calculate it, they're looking at the total value of all that money. So there's a lot there. And so one way to do it is reduce the amount that is being used to calculate that minimum distribution. So if you're retiring early, let's say 62, 63, 64, one strategy may be start spending down the IRA money first, or the 401k money first, so that by the time you do get to 72, you have less in that pot that would require a required minimum distribution. But something to be careful of is when you take money out of those withdrawals from an IRA or a 401k, it's taxed as ordinary income. It doesn't get some special benefit. It's taxed as if you earned it. And so if the government raises taxes, which they likely will, if the government raises taxes, that money is your most tax at risk money. So what you want to do is try and lower it. And if you do retire early, maybe spend that money first. Or another strategy is you can convert it.
Mm-hmm. Oh, I'm glad you brought that up because that is next on our list. Roth conversions. This is something
Yes.
we've talked about before. What do I need to run through when I'm trying to figure out if a Roth conversion is right for me?
Well, so if you almost imagine that you have money, when you have money in IRAs, 401ks, 403bs, that's all pre-tax. We call that the tax later bucket
Right.
because the taxes are going to be paid just later on. And then you have the taxed never bucket. That's money that's growing, that whatever it grows to, whatever it earns, when you take money out, it's not ever taxed. And so what a Roth conversion does is it allows a person to move money from the tax later bucket to the tax never bucket. Now, in order to get it from here to there, you got to pay taxes on it. But then what ends up happening is once you move that money in that tax never bucket, that money is completely tax free. And there's also no required minimum distributions on it as well. So a Roth conversion can help take that money out so that you have less RMDs later on. Of course, you got to pay the taxes now. And so what we got to look at is should I make a Roth conversion? The very first thing here is probably in my mind the most important. Look at the current and the future taxes. If you think taxes are going to go down in the future, then a Roth conversion probably doesn't make much sense. But in the future, taxes are likely going to go up. This chart shows what historically the taxes have been. Go back to World War II. Back in World War II, tax bracket, the highest bracket was 94%.
Mm-hmm.
You can bet that the government's looking at this chart and saying, wow, taxes are low. We have room to increase them. And if the government doesn't even do anything, taxes are already set to go higher by December 31st of 2025 because all the 2017 tax cuts are set to are going to sunset then for the individual tax rates. So we're already set to go higher. So Roth conversion can make sense because you're really getting rid of some money at current rates, which are at discounts in my mind.
Mm-hmm.
And that way, if taxes do go up in the future, at least it's not going to affect all your money. But with the stock market being down this year, and nobody likes the stock market having gone down, but it does offer opportunities because you can convert money now, get it out of that taxed later bucket and into the tax never bucket, into a Roth. And that way, when the market rebounds, which it will at some point, you're building tax-free wealth in the future.
Mm-hmm.
And that's a really good opportunity now that wasn't available, several months ago or last year even.
Right. All right, let's talk about the last strategy here, considering a qualified charitable distribution. Explain how these work, Nick.
All right, so qualified charitable distribution is where you have an IRA that you got to take a minimum distribution. And instead of taking the minimum distribution yourself, you send it to a charity. Now, here's why that works. It goes directly to the charity. Because what ends up happening, most people, they go to church, they want to give to their church, or they want to give to a charity. So they take out their checkbook with after-tax dollars, they cut a check for, say, $10,000, and they give that money to the charity. And that's all that's happened. Now, in the past, you could get a deduction. But what's happened is the standard deduction moves so high so that the standard deduction might be $14,000 to $27,000, depending on if you're single or married. So what ends up happening is you have people that are giving money to charity, But because the standard deduction is so high, the tax person's not able to actually give them any credit for it. So you get the standard deduction, but you're not getting your donation or your charitable giving actually deducted on your taxes. Now enter QCD, Qualified Charitable Distribution, where you can take that required minimum distribution. Let's say you had $10,000 of required minimum distribution that you had taken out. Now, if you took it yourself, you'd take that $10,000, pay money in taxes, and it's now in your bank, and now you cut the check to your charity. Skip having it go to you. Instead, take the IRA, have a qualified charitable donation done to where it's your distribution, to where it goes directly to the charity. When it goes directly to the charity, it's a wash. The $10,000 that you had to take as an RMD is satisfied, but now instead of paying taxes, you sent it to the charity, so now you don't have those taxes effectively, and one washes the other. And then you can still get the standard deduction on top of that, so it's almost like having this double benefit. It's a great opportunity out there.
Yeah, it's a win-win-win.
Yeah.
So again, this all just comes back to strategic tax planning, because these RMDs are income, which, as we've talked about before, a lot of people assume they're going to be in a lower tax bracket when they retire, but that's just not always the case.
No, it's not. It's a myth. I don't know where that came from, if it was from CNBC or some talking head, but there's so many people. When we have live events, we'll ask the question, how many people in here think that when they retire, their taxes will go down? And they'll all raise their hands. And the reality is, we see people day in and day out, and that's not the case. As a matter of fact, we actually see required minimum distribution. I mean, like you said, required minimum distributions are taxed as ordinary income, as if you made it. And so I have an example here of what this means. I did a tax x-ray for a couple. They are both 68 years old. Of course, they don't have to take required minimum distributions until they're 72. And so right now, their taxes are $13,000 a year on what they're bringing in. $13,000 is what they're paying in taxes. But come age 72, get this. Come age 72, their taxes are going to go from $13,000 a year to $21,000 a year. That's that's a 60% increase in their taxes. And the only reason that happened is because of required minimum distributions. And then get this. When we looked at their taxes year by year as time went on, it kept going higher and higher, 21,000, 22, 23. And they just said to me, well, hold on, we're not working anymore.
Right.
You're not, but because you have that money saved up in 401ks and IRAs, Uncle Sam's coming to collect. And as you age, he's going to make you take out more and more and more. So it's why, we had a book that came out several years ago called Diffuse. And the reason we called it Diffuse is it's the ticking tax time bomb. And it's something that can go off if you're not careful.
Wow. I think that's why it just goes to show, the earlier you can have these conversations with somebody like you, Nick, probably the better, which, begs the question, if somebody wants you to walk through any of these strategies with them, what's the best way to reach you?
I mean, especially when it comes to taxes, it's important to figure out how much unnecessary taxes you're paying. I mean, honestly, we want to legally, morally, and ethically disinherit the IRS from your money. But a lot of people, they don't know that really what the IRS, if you look at the IRS, you actually put it together, what it stands is theirs, and they know it. It's like their money, and they're going to treat it as such. And so a tax x-ray is very important, especially right now, to figure out. And that's one part of what we call our on the money 5-step blueprint process, is figuring out taxes. So an easy way to do that is people can go to our website, group10financial.com. There's so much content on there. There's links to our YouTube channel where we talk about stuff like this, podcasts where we talk about this. But another avenue is you can always give us a call at 844-GROUP-10. And so that's a great opportunity there to really set a time to go to have a one-on-one, maybe a 15-minute strategy session to see what needs to be done and if there's some red flags that need to be addressed.
All right. Nick, thank you very much. This is really helpful.
Aaron, awesome being with you again.